When it comes to raising capital for your business, two primary options stand out: equity financing and debt financing. Both have their unique advantages, challenges, and strategic implications. This video will look at the differences between equity and debt financing, and provide a comprehensive guide to help you choose the best option for your company's growth. What is equity financing? Equity financing involves raising capital by selling shares of your company to investors. In exchange for their investment, these investors receive ownership stakes in the form of equity. The advantages of equity financing are no repayment obligation, attract strategic partners, and risk sharing. The disadvantages of equity financing includes ownership dilution, investors' high expectations, and potential for conflict. What is debt financing? Debt financing involves borrowing money that you must repay over time, usually with interest. Common forms of debt financing include bank loans, bonds, and lines of credit. The advantages of debt financing are ownership retention, tax benefits, and predictable payments. The disadvantages of debt financing includes repayment obligation, increased financial risk, and creditworthiness requirements. Equity financing versus debt financing. While both equity and debt financing are viable ways to raise capital, they differ significantly in terms of their implications for your business. Here are the key differences between debt financing and equity financing. 1. Ownership and control. The most fundamental difference between equity and debt financing is ownership. Equity financing requires you to sell a portion of your business, which means sharing control with your investors. In contrast, debt financing allows you to retain full ownership and control, as you are simply borrowing money that you will repay over time. 2. Financial obligations. Equity financing does not require repayment, which can relieve cash flow pressures, especially in the early stages of growth. However, it does require you to share future profits with your investors. Debt financing, on the other hand, requires regular repayments regardless of your business's performance, which can be challenging during periods of low revenue. 3. Risk distribution. With equity financing, the financial risk is shared with your investors. If the business fails, you are not obligated to repay the capital. With debt financing, the risk remains solely with you, as you must repay the debt even if your business struggles. 4. Impact on financial statements. Debt financing appears as a liability on your balance sheet, which can affect your company's creditworthiness and borrowing capacity. Equity financing, however, does not create a liability but instead increases your equity base, which can be more attractive to future investors. 5. Investor expectations. Equity investors often have high expectations for growth and profitability, which can create pressure to achieve rapid results. Debt financiers are typically more concerned with the security of their loan and the ability to repay it, making their expectations more predictable but still significant. Factors to consider when choosing between equity and debt financing. When deciding between equity and debt financing, it's important to consider your business's unique circumstances and strategic goals. 1. Stage of business. Startups and early-stage companies might lean towards equity financing since they often lack the stable cash flows required to service debt. Equity investors are usually more willing to take on the higher risks associated with new ventures, in exchange for the potential of high returns. 2. Cost of capital. The cost of capital is another critical consideration. While debt financing typically involves interest payments, which can be a burden on cash flow, it might be cheaper in the long run compared to giving up equity, especially if your business becomes highly profitable. Equity financing might seem more expensive over time because of the ownership dilution and sharing of future profits. 3. Growth projections. If you anticipate rapid growth and increasing valuations, equity financing might be advantageous, as it allows you to leverage investor capital to scale quickly. Conversely, if your growth is expected to be steady and predictable, debt financing could be the better option, as it allows you to maintain full ownership and reap the rewards of your hard work. 4. Risk tolerance. Your risk tolerance should also influence your decision. If you are comfortable with taking on debt and confident in your ability to make regular repayments, debt financing could be the right choice. However, if you prefer to share the financial risk with investors, equity financing might be more suitable. In conclusion, choosing between equity financing and debt financing is a crucial decision that can have lasting implications for your business. Both options offer distinct advantages and challenges, and the right choice depends on your business's stage, financial situation, growth projections, and risk tolerance. Carefully weigh the differences and consider your strategic goals, then select the financing option that best supports your company's long-term success. Thank you for watching this video to the end. We hope you find it educative. Please do not forget to subscribe, like and share this video before you leave.